stock markets had increased by 150% in less than a year. There was no evidence that this was justified by dividends or fundamentals, and the bubble has burst. It has burst only in part, we're nowhere close to the earlier levels, but it has burst.
Clearly there's a lot of damage that has been done. The inclusion into the MSCI indices has to be, questioned now. There was a lot of statements that we want to give markets more importance. We didn't realize that that's what they meant.
China for a decade was really the driver of world oil demand. Over half of the total increase in world demand over a 10-year period came from China. So this kind of slowdown we're seeing in China, this rebalancing of their economy, lower demand from China, is something that is very important to the oil market, and that's one of the underlying factors that's at work right now.
The smarter investor is going to ask the question about whether or not the measures that have been put in place, large stockholders not being able to sell their shares, it's a manipulated market, and therefore this rally that's taking place, is it sustainable? And I think at higher levels there'll be questions in regards to that.
What we are seeing at the moment happening as well is that the Chinese corporations are actually also repaying their dollar-denominated debt, which amounts to $1 trillion. So an acceleration of that sell-off really could have triggered further outflows from the equity markets, which would have coincided with repayment of forex debt, which would have actually led to further significant reduction in FX reserves.